Ever wondered how your income affects your eligibility for universal credit? Stay tuned to find out. Today, we're unpacking everything you need to know about income thresholds for universal credit. We'll explore what income thresholds are, why they matter, and how they can impact your claim. In this video, we'll break down the various components that make up the income threshold and discuss some common scenarios that might affect your payments. Each situation is different, so gaining a clear view on this topic is crucial for anyone currently receiving or considering applying for universal credit. We'll also touch on how changes in your income level could alter your benefit entitlement. This is important for maintaining your household budget and ensuring you're receiving the correct amount of support. So let's get into the details. Income thresholds for universal credit are crucial because they determine how much you receive and whether you're eligible at all. Universal credit is designed to support those who are on a low income or out of work. However, the amount you get can vary significantly based on your income and other factors. To start, universal credit payments decrease as your income increases. This reduction is not one-for-one. Instead, there's a taper rate involved. Currently, the taper rate is 55%. This means for every cent you earn over your work allowance, your universal credit will be reduced by 55 pence. Work allowances are another key part of the income thresholds. If you or your partner are responsible for a child or living with a disability that affects your ability to work, you're entitled to a work allowance. This allowance means you can earn a certain amount before your universal credit is tapered. There are two rates, one for those who get help with housing costs and a higher rate for those who do not. For those without a work allowance, any income you have starts affecting your universal credit immediately. This includes earnings from employment, self-employment, and certain other incomes, such as pensions or insurance payments. Each type of income has its own rules for how much affects your universal credit. It's also vital to understand that not all income is counted in the same way. For instance, money from some types of self-employment might be assessed with a different calculation than money from a salaried job. Universal credit uses a minimum income floor, MIF, for some self-employed earners, which assumes a certain level of monthly earnings. Changes in your income must be reported to the universal credit system promptly. Failing to report these changes can lead to overpayments, which you will need to pay back. On the other hand, if your income decreases and you do not report it, you might miss out on additional benefits you are entitled to. Those receiving universal credit should also be aware of surplus earnings. If your earnings are significantly higher than your threshold for 1 month, these surplus earnings can affect your eligibility in the following months. This rule prevents high earners from accessing continuous support after receiving a large one-time income. Additionally, certain other payments like bonuses, commission, or redundancy pay might complicate the income reporting process. These are typically treated as capital, but if they're considered part of your regular income, they could affect your universal credit amount. Understanding these nuances is key to managing your benefits effectively. Each income type and change in circumstances can affect your payments differently, so keeping informed and up to date with these rules is essential. Remember, if you're unsure about how your income affects your universal credit, consulting the official guidelines or seeking advice from a benefits advisor is always a good step. They can provide personalized information based on your specific situation. Finally, remember that universal credit is designed to be a flexible support system. Its responsiveness to changes in income ensures that those who need support receive it, while also encouraging employment among recipients. This balance is central to the philosophy of the benefit system in the UK. Understanding the advantages and disadvantages of the income thresholds for universal credit can help you better prepare and manage your benefits. Here, we'll explore both sides to give you a clearer picture. One major advantage is that the taper rate and work allowances are designed to make the transition into work smoother. As you start earning, you won't immediately lose all your benefits, which helps ease financial stress and provides a buffer while you adjust to a new income. However, a disadvantage is that the taper rate of 55% might still be high for some. This means that for every sown earned over the allowance, 55 pence is deducted from universal credit. For individuals just above the low-income bracket, this can still be a substantial reduction, potentially discouraging them from seeking higher, paying opportunities. Another advantage is the responsiveness of universal credit to changes in income. This system is designed to adapt quickly to your changing financial situation, which means you receive appropriate support when you need it most, such as during sudden unemployment or reduced work hours. On the downside, the requirement to constantly report changes in income can be burdensome. The process can be complex, and the fear of penalties for errors or omissions might cause anxiety for recipients. This administrative burden can be daunting, especially for those already in challenging circumstances. An additional advantage is the inclusion of work allowances for individuals with children or disabilities. This acknowledges the extra financial pressures these groups may face and provides them with a higher earnings threshold before reductions apply, offering significant support to those who need it most. Conversely, the minimum income floor, MIF, applied to certain self-employed individuals can be seen as a disadvantage. It assumes a minimum amount of earnings regardless of actual monthly income, which can be problematic during months with low business activity, potentially leading to unfairly reduced benefit payments. A further benefit is the consideration of surplus earnings. This mechanism helps to prevent large fluctuations in benefit amounts from month to month, providing a more stable financial environment for individuals whose earnings might vary significantly. However, the complexity of income calculations and the treatment of different types of earnings can be a disadvantage. Understanding how bonuses, redundancy payments, and other forms of income affect your universal credit can be confusing and lead to mistakes or unforeseen reductions in benefits. Here is a case study related to the income thresholds for universal credit. Emma, a single mother of 2 from Manchester, was working part-time while receiving universal credit. She was struggling to manage her finances due to the reduction in her benefits as her earnings increased. Emma approached a benefits advisor who helped her understand how to report her income accurately and take full advantage of her work allowance. By adjusting her working hours and correctly reporting her earnings, Emma was able to maximize her income and reduce the stress of fluctuating benefits. The advisor also helped Emma apply for additional entitlements for childcare costs within universal credit, which she was previously unaware of. This not only increased her overall monthly income, but also provided her with more stability, allowing her to focus on her family and career development. Emma's case highlights the importance of seeking professional advice and fully understanding how different income components interact with universal credit. If you're dealing with similar issues related to income thresholds and universal credit, it's crucial to stay informed about the latest changes and rules. Always ensure your income is reported accurately and on time to avoid any penalties or unexpected reductions in your benefit. Additionally, consider using online tools and calculators provided by governmental websites to estimate your benefits based on your current income. Remember, proactive management of your benefits and income reporting can lead to more predictable financial support. If you found this video useful, please do hit that like button and subscribe to our channel.